The people who work on Wall Street, the most smartest investors in the world, with the Ivy League degrees, multi-billion dollars on the asset management, fail to beat the market 90% of the time. They're picking individual stocks and chasing short-term gains, which is a huge risk if the company goes down quickly. How can you protect yourself from that and outsmart Wall Street? By investing in ETFs. Today, I'm going to show you ETFs I'm currently invested in to build my wealth in my 20s. What is an ETF, you may be asking? An ETF is also known as an exchange traded fund, which is a basket full of individual stocks. So instead of you picking one individual stock that may go down 25% as soon as you click the buy button, you could just invest in an ETF where you would own all of the stocks. So that way, if one falls 25%, you're not losing 25% of your money. And that's the danger of investing, because a lot of people are chasing short-term gains. They're seeing a stock go up rapidly. They see it on social media, like, oh, I got to invest in that. And then this is their first time investing. They go in, they pick that stock, and then that stock has already ran up because everybody knows about it. It finally gets on your feed, and you go and you like, you know what? I'm going to put in some money. We'll see what happens. I'm trying to get rich, right? You go in, you invest, and then as soon as you hit the buy button, that's it. Everybody's like, we got them. We're selling. And they go ahead and they sell. They hit that sell button. And then now you're just like, damn, I should have never invested. And you never invest again. But that's the mistake. The mistake is investing in individual stocks. And that's why here I'm going to show you why ETFs are better than individual stocks. The first ETF I'll be talking about is SPYM. So SPYM, it tracks the S&P 500, and the S&P 500 is the top 500 most profitable companies in America. So those profitable companies are going to be tech-heavy companies right now, because a lot of them are investing in AI, and they're your biggest market cap companies right now. So like Apple, for example, should be the highest market cap, but we'll go over each sector first. Right now, like I said, technology is the top sector, which is 37%, financial services 12%, communication services 9.6, healthcare 9.2, consumer cyclical 9%, industrials 8.4, consumer defense 4.6, energy 3.3, utilities 2.2, real estate 1.9, and basic materials 1.6. You will be investing in all of these sectors by just buying one of these shares. You get exposure to everything US. Top holding, Apple 7.75, and that's because Apple is currently the #1 market cap in the world. Nvidia, number 2, Microsoft, Amazon, Alphabet, which is Google, Broadcom, advertising company, Google. So the difference between Class A and Class C, Class A, when you're buying these shares, you can vote for changes when they post out their like investor relations stuff. You could just vote, but you can't vote as Class C. Meta is Facebook, Micron, memory chips. That's what it is, memory chips. And then JP Morgan is Chase, the bank. And then the reason why I invest in SPYM instead of SPY or VOO or the Fidelity one, which I forgot the ticker for that. SPYM has the lowest expense ratio that I've seen. So that's why I invest in SPYM. And in the expense ratio, it's going to take away from your gains over the year. So as the market keeps going up, like your expense ratio, if your expense ratio is higher, because this is passively managed, like they'll take profits off of, and that's what the expense ratio is, basically just profits. But you're not physically paying these people 0.02%. They're taking it from your gains. And also looking at SPY, so today it is down, and there's just a lot of volatility right now in the market with the Iran war, Fed chair decision today. So there's just a lot of stuff, but all that stuff does not matter because we're investing in the long term. So we don't look at today, we're looking at the long term. So let's look at 5 years. It's up 65% in the last 5 years. So you see it's always going to have these up and downs. That's an example of today, right? Like it's down, but it's going to come back up. There's no reason to look at. Let's look at the next ETF, which is going to be QQQM. And QQQM is going to be the top 100 US stocks, excluding financials. So you're going to realize that QQQM and SPYM has a lot of overlap. And really, the reason why I have this in my portfolio as well is because when this goes up, it goes up a lot. And then when it goes down a lot. But SPYM can level it out. So I have them the same, like in the portfolio. SPYM is like 29% of my contributions every 2 weeks, and so is the QQQM. They're balanced out, so I can see more gains, but I also can see more losses, just depending on the year. Definitely gonna be tech heavy because that's the future right now. Like I talked about with the SPYM, this is just gonna have more concentration in tech. There's other iterations of this, but like I said, QQQM has lower expense ratio. You want them to take less gains from you. Next ETF is going to be IWM. So IWM is going to track the Russell 2000, and the Russell 2000 is going to be small caps. And I guess another term I could say for small caps are stocks that have not proven themselves yet. So these are stocks that are maybe they're new, or maybe they're just not big enough to be in the S&P 500, but you could still get exposure to these companies because maybe one day they're going to just become the next Apple. And that's why I do have exposure to it, but it's not as big as investing in my S&P or my QQQM. So I have this currently every 2 weeks. About like 17% of my biweekly contributions is going into IWM. So IWM, like it says in Robinhood, it is the market cap weighted index of the US small cap stocks, selected and ranked from 1,000 to 3,000. These are all the sectors, so healthcare, financials, industrials, technology, consumer cyclicals, real estate, energy, basic materials, utilities, consumer defense. I don't know a thing about some of these small cap companies, but you're just gonna be invested in a bunch of these companies, and maybe one day, who knows, JFrog might be the next Apple. Like, you just never know, and you can have a piece of that gain by investing in Russell. And yeah, that's all I can really say about the Russell 2000. They're just small companies that I just want to have some exposure to. It has a pretty decent expense ratio, so that's why I don't mind holding it. That is IWM. The next ETF that I invest in is DIA. And DIA tracks the Dow Jones Industrial. And the Dow Jones Industrial Average, I'm going to say elite companies by Wall Street standards. They're considered blue chip stocks because they have a long track record. They've been in the stock market for a long time. Like, they make a lot of money. They're very profitable. They pay dividends. These stable companies. Now, yes, I know looking at the market today, it's down 2%. Like I said earlier, the market, there's just a lot of news that happened today. So it's probably the worst time to look at the day, but this is actually the best time to be investing because you basically get a 2% discount if you wanted to start buying today. But the market's closed, so you can't buy today, but you can buy in the morning. That's besides the point. Okay, like I said, DIA, 30 large companies that have proven themselves. They pay good dividends. If you are going to follow this ETF strategy, this would be like your most stable. It will grow like over a long period of time. Like, it's going to be consistent gains. You see, like, the dips are not as steep as the S&P chart or the QQQM chart. Like, it's going to be more stable, but that also means that it's not going to grow as much. That's also why, you have some exposure into this, but not as much if you're younger. So you got financial services, industrials, technology, healthcare, consumer cyclical, communication services, consumer defense, basic materials, energy. And then these are the companies, the top 10 holdings. These are just going to be more stable stocks, less volatile. So if you want a more safer ETF, this is a pretty decent ETF, and it pays pretty good on dividends. Like, the dividend yield is a bit higher, and it has a pretty good expense ratio. So that's also why I invest in it. And about 20% of my biweekly contributions goes into DIA currently, as high as the S&P or the QQQM. And then my last ETF, Bitcoin, is a Bitcoin ETF. Bitcoin is just a hedge against the US dollar. So if you think the US dollar is just going to keep going down, people use Bitcoin a currency holder where they will invest in the Bitcoin as the US dollar falls down, then Bitcoin should rise up because Bitcoin has a finite amount, so it's not a inflationary money supply like the US dollar is. Bitcoin is more like a deflationary money supply. Once we mine all the Bitcoins, then that's it. There's no more Bitcoins to be made. A hedge, like I'm using it as a hedge. So right now, currently, it's about 1% of my current Roth IRA total, like amount that's invested, and I want to scale it up to 5%. So I did have Bitcoin last year before the crash. I started selling it before the peak when it was at like 110, but then I completely sold out of it, starting to ramp it back up now that it hit like 60,000. I've been buying, so I've been adding towards it. So again, just extra bonus ETF. Wouldn't recommend it for everybody because, like I said, Bitcoin is extremely volatile. If you bought this ETF last year, bought it at the top, you would be crying right now. Different outcome for you. You'd be like, oh my God, Bitcoin is like the worst thing to invest in. But I like started investing in Bitcoin when the ETFs first, right around this point. I like rode it up. Well, this is the 5 year chart, but in the middle between that bar and this bar is like when I started to sell it because I was like, okay, when I started seeing people talk about Bitcoin that I know knows nothing about investing, that's when I knew we was at the top. It was like, okay, I'm going to slowly start selling out. I would say I didn't time it perfectly, but around the September time, I definitely completely out of it. It's been down, but I've been slowly adding back now. Not saying it's a good time to buy. It could keep dropping, but I think it fell enough, and I'm gonna rebuy now. But now below what it was trading for when the ETF first started. I'm just gonna arbitrage it, and we'll see. Maybe it goes back up, and then I could do it all again. So now you see where all the ETFs are that I'm currently invested in. If you've been keeping up with the YouTube channel, last video I showed how to set up recurring investments. This video I just showed you how to power those recurring investments by picking the right ETFs, where you have a basket of different stocks. So instead of me now having 5 stocks that I'm investing in 2,500 different stocks. If you like this video, make sure you give it a like. If you are going to follow these ETF strategies, let me know which one you thought was your favorite one in the comments down below. And make sure to subscribe if you want to see more videos like this one. And for the next video, I'm going to compare the difference between investing in a taxable brokerage account versus a Roth IRA. Thank you for tuning in to the channel. Zillennial Mindset out.